Pat and Greg here at NewEdge Wealth in Miami, and we're going to talk about private equity, the past, the present, and the future of the asset class. And with that, we're going to turn our first question over to Greg as we look through some of these charts from Hamilton Lane, which is just this exhaustive report looking through the last decade's returns in private equity. Greg?
Yeah. So, even though we're calling it past, present, future, why don't we start with the present? And the present and the recent past is that people generally are not thrilled with the performance of their private market holdings. And so this isn't, a shock. And if we look at how well the S&P and the MSCI world has done, it's done very well, quite a bit better than growth equity, privates, venture capital, and real estate. And, this makes some sense given the impact that rates have had. That has certainly hurt both performance and liquidity. And so, even buyout funds, which have done reasonably well in that, people aren't getting their money out. So we're in an environment where people are complaining about their performance in private markets and asking, should they be doing this? The other data that they showed we thought was very interesting about the present is just, an acknowledgement of how big these markets have become. If you look at how much money has gone into the private market segments, it's increased dramatically really since 2021. And again, that means that, it's reasonable to expect returns to be less good going forward, but it's a huge market today.
And there's a lot of niches within the market.
That's right. But I think, this is an important slide to provide, more history. And so when we look at the past, the truth is that, private equity, despite having some challenges in recent history, has really done quite well over time. And, some of that was a beneficiary of the zero rate environment, but some of it we think is the fact that there isn't a liquidity premium. And if you have good managers, their ability to really create value with private companies operationally and potentially in the capital structure really makes sense. And the performance of private equity over time confirms that.
Yeah, I think my one takeaway, it might not be as dramatic on a relative basis compared to public markets as it was in the past.
Yeah, and that's true. And I think when we talk about how much we like private credit, we do really like private credit, but it's important to realize, you don't have that capital appreciation potential that you have in something like private equity. So where does that leave us today and going forward for the future?
Yeah, and so one of the things that, we really believe is that fees and taxes really matter. And the simpler the structure for a client, the better. And what's happened in this space is there's innovations happening here. One of the big innovations is these evergreen structures, which are not really new, but the bigger firms are all coming out with evergreen structures, which just means where you make a decision to invest in a private equity fund, all your money goes in day one. So you're fully invested day one. You have access to liquidity, subject to gates, but you do have access to liquidity. In many cases, the fees are lower. You don't have the drag of having a capital call where you have to keep cash someplace else. And when you have a gain, it's reinvested, as opposed to being paid back to you, right? So all those things, that money going back and forth to the funds, create tax inefficiencies, compounding inefficiencies. So in theory, these structures should be better. So there's only 11 of them around. And this little chart here, the one in the middle, shows you that the 11 evergreen structures that exist today over this relatively short time frame actually outperformed the PE averages. And why is that? Well, we highlighted that as the ability to put all your money to work on day one gives you the magic of compounding returns that Warren Buffett always talks about. And we always talk about with direct indexing. The evergreen manager immediately reinvests the proceeds into new investments. So it's not sitting on the sideline. And that keeps that eighth wonder of the world working in your favor. And if your evergreen fund delivers the magical 12% return over 10 years, which it may or may not, this is not a heroic return by historical standards, then you will actually get 2.5 times your initial investment over time. Only about 6% of actual private equity funds do that 2.5 times. And that's because of the compounding factor. So the compounding factor might actually drive your returns higher. So this is just something to think about. And the conclusion of this institutional manager is that they believe that these evergreen structures are going to be the way forward in private investments. This is the way institutions are going to use, individuals are going to use, because it's a better structure. It's less expensive with, at the very least. You're not going to be paying all these wrapper fees and all the rest of this stuff to big banks. So we think this makes sense, and we're going to really look hard at adding these types of structures to our portfolios over time. because we think that's in your best interest.
Yeah. So I think, the real takeaway here is if you go back to our recordings almost 2 years ago, we said we weren't looking to allocate a lot of money into private equity. And some of that was the fact that rates are now higher. So it was a higher hurdle. Some of it was that there's a lot of money. And so returns shouldn't be as good as they were in the past. But a lot of it was the fees and the investment structure. And the truth of the matter is the evergreen structures that are coming out today really make the proposition of the private equity funds we're looking at more attractive. And we think as a result, warrant investment from our firm.
Yes. So where we will use active management is in these evergreen structures. That's where we'll pay for it. Because we do think there's a potential for diversification, outperformance for clients. And frankly, the liquidity factor is huge because it's the opportunity to make changes if we need to in the future to rebalance. So thank you for your time.
Thank you.